Hi guys, how's life? I pray that all of you have a wonderful and peaceful day. Another important topic that I will be discussing in today's video. But before anything else, please allow me to read our good news. From Romans chapter 12, verse 12, Rejoice in hope, be patient in tribulation, be constant in prayer. And for today's discussion is all about accounts receivable and its components. Our target for today is to understand accounts receivable and its importance in company's operation. And for the purpose, this is timely collection of company's receivables to eliminate overdue accounts. Okay, let me first discuss what is accounts receivable. It refers to money due to a seller from a buyer who have not yet paid for their purchases of goods and services on credit. This money is typically collected after a few weeks and it is recorded as an asset to your company's balance sheet. You use accounts receivable as part of accrual basis accounting, meaning revenue is recognized when it is earned or invoiced, and expenses when they're billed but not yet paid. Unlike in cash basis accounting, it recognizes revenue and expenses only when the money is transferred to the actual recipient. Next, why is it important to monitor accounts receivable? Because it helps the company make sure that they are collecting their money in order to cover short-term obligations without additional cash flows. Okay, what is the purpose of managing accounts receivable? This is to maximize cash flow while minimizing cost and maintaining good client relationships. Okay, how to monitor and control accounts receivable? 1. Check the credit status of new customers. 2. Invoice promptly. 3. Consider offering discount for early payment. And the last one, prepare accounts receivable aging schedule every month and monitor past due accounts. Okay, accounts receivable is recorded in the balance sheet at net realizable value, and it is under the current asset of balance sheet. Net realizable value meaning is after deducting the bad debts. Bad debts or uncollectible accounts will be discussed further on the next slides. Okay, how to calculate bad debts or uncollectible accounts? We have to check aging of receivables, check accounts that are long overdue, estimate expected percentage of uncollectible accounts based on historical data, and the last one, multiply percentage of collectibles or uncollectible accounts to those long overdue accounts. Actual sample will be discussed on the next slides. To have a better understanding, showing you aging of receivables sample number 1 that can be used in your monitoring. I intentionally separate these two accounts to correlate it with the succeeding slides in the computation of bad debts and collectible accounts where the over 121 days overdue amount was used. I also included in these slides the previously recorded accounting entries as also shown in our previous vlogs, which debited accounts receivable, cost of sales, we credited sales and inventory for both transactions. How to calculate bad debts or uncollectible accounts? Based on the aging of over 121 days, we have a total overdue of 602,000. Then multiply by 23.41% based on historical data. So we have a total of 140,940, and this is the estimated bad debts to be deducted from the total AR when presented to balance sheet. As mentioned, sample number 2 was populated with the complete transactions for your immediate reference. This report is prepared through Excel that shows your customer code, customer name, last month balance, sales, collections, adjustments if there's any. Last month balance plus sales less collections plus or minus adjustments equal total AR. Total AR can be categorized into not yet due and current plus overdue accounts. The overdue accounts is composed of 1 to 15 days, 16 to 30 days, 31 to 60 days, 61 to 90 days, 91 to 120 days, over 121 days. For XXX company, we have last month balance of 14,500, no sales, with collection of 14,500, and the total AR is 0. For ZZZ company, we have last month balance of 30,000, 2,000 sales, no collection, total AR is 32,000, which composed of not yet due of 2,000, current of 15,000, and overdue of 15,000, where 10,000 is 1 to 15 days overdue, and 5,000 is 16 to 30 days overdue. For XYZ company, we have 100,000, 5,000 sales, collection of 45,000, adjustments of 250, and the total AR of XYZ company is 60,250, wherein 5,250 is not yet due, current is 30,000, and overdue is 25,000, 5,000 of which is 1 to 15 days overdue, 2,500, 16 to 30 days overdue, 31 to 60 days overdue is 3,000, and 61 to 90 days overdue is at 14,500. The last one is Industry. Last month balance is 100,000. Total AR is 100,000. No sales, no collection. Not yet due is 5,000. Current is 30,000. Total overdue is 65,000, where 5,000 of which is 1 to 15 days overdue. 16 to 30 days overdue is 2,000. 31 to 60 days overdue is at 50,000. 5,000 is 61 to 90 days overdue. And 91 to 120 days overdue is 3,000. By the way, the not yet due accounts are those sales that are not yet due for collection, while current and total overdue are sales, are receivables that are due for collection. That ends the discussion of accounts receivable. Should you have some inquiries, please let me know by writing in the comments portion. I hope you have learned something useful again. Please subscribe. VLL Love Educational and Leisure. Like and share. Hit the notification bell for more updates. The next topic is how to fill out cash sales invoice and its usage. You can also watch our previous vlogs as seen in the screen. Thank you guys, thank you Lord, and God bless us all. Bye for now!